Welcome to the Explainer. If you're preparing for competitive exams, you know that keeping up with the latest economic data is absolutely crucial. So today, we're going to do a complete breakdown of India's economic report card for the first half of the financial year.
So, the big question is, how's the Indian government doing with its finances 6 months into the fiscal year? Is the money coming in as planned? Are they spending it wisely? Let's dive right into the official numbers and get the real story.
And we're not just pulling these numbers out of thin air. We're going to decode the latest figures straight from the Controller General of Accounts, or the CGA. This explainer is designed to give you all the essential data, the key concepts, and the major trends you absolutely need to know for your exams.
Okay, here's our game plan. We'll start with a broad look at India's fiscal health. Then we'll follow the money. First, where it's coming from, which we call receipts, and then where it's going, which is expenditure. After that, we'll get into the deficits, and we'll wrap it all up with a super handy list of key takeaways for your exams.
All right, let's jump into our first section. We're starting with the big picture, a mid-year snapshot of India's overall fiscal health.
First things first, where is this data from? It's from the Controller General of Accounts, the CGA. Now, for your exams, this is important. You should think of the CGA as the government's head accountant. They are the principal accounting advisor, and their reports are the official, most reliable source for tracking the country's finances.
Now that we know our data is solid, let's start following the money trail. First stop, the government's income. Where is the cash coming from?
In government speak, income is called receipts, and it's split into two main buckets that you absolutely have to understand. First, you have revenue receipts. This is the regular, recurring income like taxes. Then you have capital receipts, which are more like one-time gains, things like recovering an old loan. Getting this difference is fundamental.
Okay, this table tells a really fascinating story. You can see that overall revenue receipts are at almost 50%, which is a little behind last year's pace, but look at the lines below. The real headline here is the incredible performance of non-tax revenue and non-debt capital receipt.
Just look at that number. Non-tax revenue has hit nearly 80% of its entire yearly target in just 6 months. This is a huge deal. This surge is mostly thanks to big dividends from the RBI and other public sector companies. It's a massive boost to the government's wallet.
So, we've seen the income side of the balance sheet. Now let's flip over to the other side, expenditure. Where is the government actually spending all this money?
Just like with receipts, spending is split into two types. You've got revenue expenditure, that's for the daily running of the country, stuff like salaries and pensions. Then you have capital expenditure, or CapEx. And this is the exciting one. This is spending that creates long-term assets. Think highways, ports, hospitals. Here's a quick mnemonic for your exams. Just remember RC. Our revenue expenditure is for running the country, while capital expenditure is for creating new assets.
And here it is, folks, the biggest story of the year so far. The government has seriously front-loaded its capital expenditure. They've spent an incredible 51.8% of the entire annual budget in just the first 6 months. That's more than half the year's investment already put to work.
And to really understand how massive that is, just compare it to last year. At this same time last year, the pace was only 37.3%. So this jump shows a very clear, very deliberate strategy to speed up infrastructure development.
So why are we making such a big deal about this aggressive CapEx? Well, it creates what's called a multiplier effect. Every rupee the government spends actually generates even more economic activity down the line. It creates jobs, builds assets for the future, and this is key. It encourages private companies to invest too. This makes high CapEx a central pillar of the government's entire growth strategy.
Okay, so we've looked at the money coming in and the money going out. Now it's time to put it all together and check the final balance sheet. When spending is more than income, you get a deficit. Let's see how the numbers are looking.
Now, the most important term you'll hear is fiscal deficit. All it is the gap between what the government spends and what it earns. It's the total amount of money the government has to borrow for the year. Here's a mnemonic to lock it in your brain. F, fiscal deficit, is the final difference that has to be covered by borrowing.
So as of September, the fiscal deficit is at 36.5% of the full-year target. Now, that is a bit higher than last year's 29.4%, and it's a direct result of that accelerated capital spending we were just talking about.
Okay, another key term, revenue deficit. This happens when your day-to-day spending is more than your day-to-day income. You know, it's like using a credit card to pay your electricity bill. It means you're borrowing just to cover operational costs, which is generally not a good sign for an economy. A high revenue deficit is a major red flag. But here's some really good news. The revenue deficit is at a very, very low 5.2% of the annual target. This is a fantastic sign of fiscal discipline. It shows that the government is borrowing to build assets, not just to pay its daily bills.
Phew, that was a lot of data. Now, let's boil it all down into a single, power-packed summary slide. This is perfect for your last-minute revision. All right, this is your exam cheat sheet right here. The number one story is the massive push on capital expenditure, hitting 51.8% of the target. On the deficit side, the main fiscal deficit is at 36.5%, but crucially, the revenue deficit is super low at 5.2%, which shows good management. And on the income side, the star is non-tax revenue at almost 80%. Make sure you know these bolded figures and concepts inside out.
And this all leaves us with the one big question that economists are now asking. The government has made a strong start on building infrastructure, but can it keep up this pace while also keeping the overall deficit under control for the rest of the year? That is the economic tightrope they have to walk now.
We really hope this detailed breakdown helps you with your preparation. For more deep dives on other topics that are just as crucial for your exams, please be sure to check out the other explainers on our channel. And hey, if this explainer was useful, please hit that like button, share it with your friends who are also preparing, and subscribe for more content that's designed to help you succeed. Your support really helps us make more of these. All the very best for your exams.